Welcome to the first in a series of 4 webinars about the business considerations of running a farm. In this series of webinars, we will be looking at the tools and analysis that a farm can do to be profitable. The first webinar focuses on the primary financial statements used in a farm operation: the balance sheet, income statement, and cash flow projection or budget. These 3 financial documents provide a good solid base for any financial analysis. In the second webinar, we will take the financials and learn how to do some common and simple analysis on them. Lenders will request most, if not all, those financials, and will do some of the same analysis we do before lending capital. Working with a lender is the topic of the third webinar. And the fourth webinar will discuss tax planning, which is essential to the success of any farm business and for the farm to last for future generations. So with that, let's go ahead and get started. And before I forget it, a little bit background on me. My name is Sarah Horner. I'm an agricultural lender for Flanagan State Bank. I also have a degree from the University of Illinois, and I farm myself. So a lot of these things I'm telling you to do, I do on my own farm. So to get started, what is a farm? I'm sure if you ask different people their definition of a farm, you would get a lot of different answers. In the end though, for most people, a farm is a business, which means the main purpose is to make money. That is what it should be in your head as well, because if you're not making money, you're not going to be farming for very long. So treat your farm like a business, take the emotions out of it and run it like a business. What is the goal of every business? Well, the primary goals of all businesses should be to increase revenue, decrease expenses, and to reduce risk. It sounds really simple, but as most of you already know, it is easier said than done. I highly recommend keeping those 3 things in the back of your mind as you go through these webinars and as you run your farm business, though. Those goals are not effectively accomplished without accurate, timely, and detailed farm records, though. Your farm records are the most important tool that you will have on your farm operation. But if you just remember those 3 things, it kind of simplifies everything else. The most important thing a farmer can do to benefit their business is to have timely and accurate records. They are the foundation of all sound business decisions. Good farm records lead to accurate financial statements, which eventually leads to achieving the 3 goals that we just talked about, which eventually can lead to profit. But that, again, that's easier said than done. Like I mentioned before, I will give you the tools to be able to do basic financial statements and analysis to meet those goals. But these financial statements cannot be done without good financial records. And we will talk about records also in the second webinar series. Our agenda for today is organized in the same way that I like to run my meetings with my customers. We first look at the past to see how they have performed so far using their income statements. Then we put together a balance sheet to see where they are today. And finally, we look into the future using cash flow projections, also known as budgets, to help them meet their goals. So with that, let's go ahead and get started. We are going to talk about farm records today because you can't do these financials without the farm records. For many farmers, bookkeeping and financial analysis is their least favorite part of running a farm. But it cannot be understated the importance of having good, accurate farm records to make sound business decisions, though. A lot of your time will be spent in front of spreadsheets, on the phone with vendors, looking at receipts, and doing your records, which also leads me to all this that we do today can be done in Excel. So if you don't know how to use Excel, I highly recommend either taking a general Microsoft Office course or adding to that an Excel course as well, so you can learn how to do additional equations and how to better utilize Excel for your business. So what should your farm records do for you? First, they can help you compute accurate break-even costs on crops and livestock. Your break-even point is the amount of revenue you need to cover all your operating costs. If you have more revenues than expenses, then you are above your break-even point and you're earning a profit. If you're below your break-even point, then your farm is not making money. Your goal is to price your products to cover your operating costs. The second thing it can do is it can help you make accurate and timely business decisions and make those decisions easier. Running your own business can be very stressful. Don't add to the stress of it. Make sure you have your records and are doing them, keeping up with them, so that when you need to make a business decision on a moment's notice, that you have all the information available. You make these decisions using financial analysis tools, which we will cover in the second webinar in this series on how to analyze these financial statements. They should tell you what makes you money and what you spend your money on. Once you have good records, you can review them with a consultant to help improve efficiency, production, and profitability. A consultant could be someone you pay, such as a farm manager or an accountant, or it could be a banker who understands agriculture, or it could be someone such as the Land Connection that has anybody who has knowledge, who is an objective third party who can take a look at your financials and kind of give you an objective opinion about what's going on in your operation. Good farm records also help you with cash flow and cash flow management. They allow you to compare monthly actuals to your projected income and expenses, which we will look at in the future section of this webinar. Your goal is to strive to at least break even to being profitable, and you need to build your working cash every year. Basically, your working cash is kind of your savings. Your farm records can also help you with tax planning. The fourth webinar in this series will deal with tax planning. Your goal should be minimize taxes, not eliminate them, and to plan tax obligations to your schedule. If you're not paying taxes every year because you have a negative net income on your Schedule F, that means your farm did not make money. You need to make sure you're minimizing your taxes, minimizing your tax liability, managing it, not eliminating it. And then finally, the more you know, the better the decisions you will make as an owner or manager on the farm. So now that we have discussed the importance of good farm records, we can put those records to work by analyzing what has already happened. The financial I use as an ag lender to analyze how my customers perform in the past is the income statement. And some people might call it a profit and loss statement. An income statement reflects a business's revenues and expenses for a period of time. It is important to note that it is for a period of time. I have that underlined and bolded for this purpose. There is a start date and an end date. The period can be anything you want. The easiest and most common period is to use a calendar year, which means January 1st to December 31st. And the reason being is a lot of people use that time period is used for your taxes. So it's easier just to kind of do one set of books. If your fiscal year should end in like August or something, you may have a different time period, or you may want to run your income statements by the quarter, first quarter, second quarter, third quarter. So then that period of time will change. But again, most people, what they have time for and are able to do is January 1st through December 31st. There are two types of income statements, accrual and cash basis. Accrual records revenues when they are earned and expenses when the benefit of the expenses are used. And that's not necessarily when they are received or when they are purchased. Cash basis records revenues at the time they are received and expenses at the time they are paid. So what does this look like in practice? Let's start with the most common and the easier of the two, cash basis. Cash basis allows more flexibility with how income and expenses are recorded, which allows more flexibility for tax planning. For taxes, you can't switch back and forth between accrual and cash basis filing. You have to choose one, and that's the basic method you use every year. But when reviewing and making decisions for your own farm, I recommend using both. We use both on our farm operation, and that's because there's benefit and drawbacks to each one, and they tend to complement each other very well. As I mentioned, this is the most common method that people will use for filing taxes. This allows them to limit their tax liability more easily. So if you had a year where you had a lot of revenue, you may have some room to pay off some expenses to help limit that tax liability that you will owe. As a lender, if a customer does not have an official cash or accrual income statement, then we rely on the Schedule F of the farmer's 1040 return to evaluate the profit and loss of a farm from the previous year. In those cases, it gives us the most complete record of a farmer's performance. It is not the most ideal thing to use for an income statement, but at the same time, it's better than anything else we would have at that moment. The downside is that it does not account for revenues that you have earned but not received, or for expenses that have been incurred but not yet paid. It also can include prepaid expenses that are for the next year's crop. So expenses that have been paid but not yet used. So it might overstate some expenses, or it could understate revenues. I mean, it's basically anything that enters your account and leaves your account. So if you have a checking account that's just for your farm, it's all your debits and all your credits throughout the year. It's anytime cash exchanged hands, not when it was earned or when it was used. For our examples, for the examples we use today, we're going to simplify it. We're going to do January 1st through December 31st. Again, if your time period for your income statement is January 1st to December 31st, then you can use these to help file your taxes. So it's two birds, one stone, basically. You can have your financial document to help you do analysis, but then you can also give it to your tax accountant so they can file your taxes for you. Okay. So in the top section of every income statement, including your Schedule F, is your income. Using cash basis, you would include any revenue that you received during the period you are covering. I also highly recommend breaking it down by income source as much as possible. That way you can tell what is making you the most or least amount of money, or even if it's related to your farm production. Underneath the income section is the cash farm expenses. In this section, you include anything you paid in your selected period of time. Anytime money has left your account or you swiped a credit card for the farm, those expenses should be properly categorized. A good guide for what categories you can use is on the Schedule F that is used in the 1040 tax return. It has the expense categories you will need for your taxes, and that way you don't have to do two separate set of books. If you use your January 1st through December 31st income statement for taxes, then you will already have everything lined up with what you need. So at the end of all that, when you have all your income sources, you add them up to get your total income. And we'll also refer to this as your gross income. And then at the end, you'll add up all your expenses to get your total expenses. So this is what it looks like over on the right here. You have this TLC Farms is what we'll be using for our example. They made $46,000 from produce sales and $3,500 from egg sales this year. And they have gross farm income of $49,500. I pulled these expense categories right from the Schedule F of the tax return. So it's just real easy for me to take TLC Farms. TLC Farms can take this and give it to their tax accountant. So at the end, you'll see a net cash farm income. Once you have your income and expenses recorded, then you can calculate this. You calculate this by subtracting your total cash farm expenses from your gross farm income. So basically, income minus expenses equals net income. Now, if you look also at their net cash farm income right now, using cash basis, it looks like TLC Farms did not make money. In fact, they're in the hole $1,875. But remember, that could be because their revenues are understated. There's accounts receivables they haven't accounted for, or they have expenses that are from previous year's production. So you're not sure whether your production activities are actually losing you money or making you money at this point, because you haven't accounted for those items that you need to take out or add in. So real quick again, net farm cash is gross income minus total cash farm expenses. So again, whenever cash enters your account or whenever it leaves your account. And an accrual income statement will account for those items that were not used or a result of production in your current fiscal year. Using accrual adjustments will give you a more accurate picture of your true revenues and expenses in a given time period. The downside to using an accrual income statement is it involves a little more work than cash basis and requires more detailed record keeping. You're going to need to know whether when that revenue was earned, and you're going to need to know for what year that expense was for. You make your accrual adjustments by subtracting out the income and expenses or adding in that were not earned or used in your fiscal year or that time period you are covering. So again, this is more complicated, but it is way more accurate, and you're about to see why. To calculate your accrual adjustments, I recommend separating them into 4 categories. Accounts receivable is the money that you have earned and is owed to you, but has not been paid yet. Accounts payable is money that you owe for expenses you have used. For example, if you have a bill for a tractor repair, but have not paid it yet, then it would be considered a payable, an accounts payable. Next would be accrued interest. That is interest that is owed on debt, but it has not been paid. And lastly, there are prepaid expenses. These are expenses that you have paid ahead of time, but have not yet used. For example, if you purchase, let's say you purchase some seed for 2022 at the end of 2021, then that would be a prepaid expense because you have paid ahead, but have not used the item or service yet. In every case except prepaid expenses, you need to take the balance of each accrual at the end of the year minus the balance at the beginning of the year to get your accrual adjustment. In the case of prepaid expenses, you do the opposite. You would take the beginning of the year minus the balance at the end of the year. The reason is that the balance that you have at the beginning of the year will be expenses you used in your current production year. The balance at the end of the year will be expenses that you prepaid for next year, for 2022. So if you make any purchases for your 2022 production year before the end of 2021, that needs to be taken out of consideration for your accrual income statement. It is important to think of each category. It is important to think of how each category affects your net cash income. What do I mean by that? And how should you set up your accrual calculations? We're about to go over that. So next slide here. Using the TLC's farm income statement as an example, when they go to do their accrual adjustments, it will help them to think about what the beginning and the ending of the year represents. For example, if there's an accounts payable balance at the beginning of the year, then that would have been for items used in the previous year, not the current year. Anything that you had in January 2021 as an accounts payable could not have been used in 2021 yet because it hadn't started yet. You basically used something at the end of 2020, and then you didn't pay it till 2021. So that's why accounts payables, for example, and receivables and interest represent the previous year. It's something you earned last year, but it carried over and didn't get paid till the next year. The key is to subtract the non-current year from the current year you are currently working on. That's a lot of currents, but basically saying if it wasn't used in this year's production, you don't need to have it. It needs to be subtracted out. So this is what it looks like in practice. And first of all, I know a lot of this can be overwhelming. This is probably the hardest thing I'm going to show you today are accrual income statements. But again, once you get the hang of them, you're going to love them as a tool for your business. So this is what it looks like in practice. TLC Farms use $6,000 worth of fertilizer for which they have not paid yet for the 2021 crop year and carried over a balance of $9,000 from the 2020 crop year. They still owe $1,000 worth of real estate taxes from 2021, and they will carry into 2022 and owe $500 from 2020. So you'll see it over there. I have the beginning year balance in one column, the end of year balance in another column. And what you do is you take the end of year balance minus the beginning of year balance to get the accrual adjustment. So this gets you your accounts payable accrual adjustment as an entire category, which is in this case, negative 2,500. And we'll discuss what to do with that negative 2,500 coming up. If you look at the first chart, you can see that the beginning balance for prepaid is your current year and the ending balance is for next year. Like I said, prepaids are different than the other categories. Prepaid expenses are essentially the opposite of accounts payable. You have paid for something but have not used it. In our example, TLC Farms prepaid $8,000 of fertilizer and seed for 2021. So that is our current year. 2021 is what we're working in right now. Their ending balance is $3,000 for fertilizer and $13,000 for seed. The ending balance for 2021 will be prepaying for your 2022 expenses and needs to be taken out. So to get the prepaid accruals, you subtract the ending balance from the beginning balance. So here you have fertilizer. Let's say there's a farmer up the road that you get manure from that spreads it on your fields. Beginning of the year, you paid $8,000, or that's your balance. And at the end of the 2021 year, you have $3,000. So you take 8,000 in this case, minus the 3,000, and that gets you 5,000. You can also prepay on fuel and oil. So the beginning of the year is 2,150 minus 1,075, and that gets you an accrual adjustment of 1,075. Overall, you have an accrual adjustment of $1,075. So where does that leave us? Let's say we already calculated accounts receivable and accrued interest. I didn't show you those examples, but let's say we already did that. We now have everything we need to make our accrual adjustments. Like I mentioned on the last slide, make sure you are thinking about how that accrual affects your net cash income. Having a positive accounts receivable means that this farm has earned revenue that they have yet to receive. So taking out beginning balance from the ending balance, they have a positive 1,350 in revenue that has not been paid yet. How do you know how an accrual affects net income? One easy way to think about it is to do your accruals like they're listed in the chart, specifically the effect on net cash column times your accrual adjustment. For example, if you take a positive accounts payable, that means you are increasing expenses. Increasing expenses means you are decreasing net income. So that positive prepaid was not necessarily a good thing. It means we were adding to expenses, which means we have to decrease net income. So in TLC's farm case, they had a negative 2,500 adjustment for accounts payable. Accounts payable has a negative effect on net cash. Anything that's expense is going to have a negative effect overall as a category. So take negative 2,500 and multiply it by -1. That gives you a positive final accrual adjustment. You are basically reducing your expenses, which will increase your net income. It essentially means that your cash basis expenses are overstated because you have included expenses that were not used in your current year. So you need to add them back into your net cash income, which if you recall, your net cash income is your gross income minus your expenses. So basically during this time period that we're running this for, we had items that didn't belong, that wasn't for this production year. So let's talk about the prepaids, because the prepaids are always weird, right, in accruals. Prepaid expenses were a positive 1,075. That means some expenses were paid for 2021 that were included in 2020's cash income statement, because that's when TLC Farms paid their vendors. So we need to increase our expenses, which means that it has a negative effect on net cash income. You have increased your expenses, and anytime you increase expenses, that's going to make your net income go down. So in our example, I took the positive 1,705 times a -1, since prepaid expenses have a negative effect on net cash income. That means you will subtract 1,705 from your cash income. TLC Farms is essentially increasing their expenses, which means less net income. I'm saying net income a lot, but you just have to think, how do expenses and income affect your net income? If using the effect on net cash column is too confusing, again, just ask yourself, is this accrual increasing or decreasing revenue or expenses? And one last time, because in case you didn't get it, I would also write this down. If it's increasing revenue, then your net income will go up. If it's increasing expenses, then your net income will go down, and vice versa. If you are decreasing revenue, then your net income will go down. And if you are decreasing expenses, then your net income will go up. It's kind of the opposite effect, but you just have to think income good, expenses bad. So one's going to cause it to go down, the other is going to cause it to go up. I would also like to note that accruals, and I said this before, are not easy. This will probably be the hardest thing you learn today. Accruals rely on you having really good and detailed farm records. There are times where I even have to slow down and think about what am I looking at and for what year. If you follow the first chart on this slide where it says what year is the beginning balance, what year is the end of the balance, and just kind of shift it for the years you're looking at, then correctly apply the effect on net cash, and you should get accurate accrual adjustments. The more you do it, the better you will get at it. This is something that was even hard for me when I first learned it, but again, it's something I do on my own farm, and I highly recommend you do as well. So let's take a look at the final product here. So we're not quite done yet, but we will get there in a minute here. So we have your net cash farm income. We had it at negative 1,875, if you remember. Now we're going to factor in the accruals we did on the previous slide. So when we look at that, we're looking again at only the stuff that we used or earned in 2021. There's no carryover from 2020. There's no prepaid expense for 2022 included. In the case of TLC Farms, they did make money from their 2021 operations. Their farm activities gave them a net farm income accrual of $900 profit. Now, it doesn't always work out that your accrual net income improves, though. Sometimes it shows you it didn't make money, but that's when adjustments have to be made. So TLC Farms right now is sitting really good. You factor in your accrual adjustments, and again, sometimes it'll be good, but sometimes it'll be bad, but it will always be the most accurate picture of how you did in a given year or a given time period. So once you get your net accrual farm income, then you have the option of adding in non-operating or non-farm income and expenses. For example, when I do my own financials, I keep my farm income and farm expenses separate from my non-farm income and expenses. It helps me analyze how my farm operation is doing it each year, or for whatever period of time I'm running my income statement, separate from any personal items I have. So it's business and then it's personal. So the addition of off-farm wages, for example, minus family living, minus term debt, minus income taxes will give me a picture of how I'm doing financially overall. Again, that's your net income, your accrual net income that we just calculated, plus your off-farm wages, minus your family living, minus your term debt, minus your income taxes. That will get you your overall net income for you as a person. We often see cash flow projections or income statements that do not account for family living, term debt, and income taxes. But just like if you were to work an outside job, a job outside the farm, you get a paycheck and you pay your bills with it. The same thing needs to happen with your non-production expenses, such as term debt, income taxes, and family living. Your farm should be able to pay you some sort of income or wage. From that, you will need to pay the principal on that tractor loan, or pay your income taxes, or pay for gas in your personal car, or for groceries. Having these totals are an integral part of analyzing a farm as a business and troubleshooting if there is a problem. So over here on the right, we see their net farm income. we see that TLC farms, someone has an off-farm wage of $40,000 a year. They spend $35,000 on their family living, and they have term debt of $2,000 that they pay to the bank, and they have income taxes of $2,500. So we take that $900 plus the $40,000 minus the $35,000 minus the $2,000 minus the $2,500, and that gets us to an overall net income for TLC farms and their family of $1,400. One of the most common issues we see as ag lenders is when the farm is making money, but overall the farmer is financially stagnant or worse off than the previous year. Oftentimes what we see is that the farm itself, again, is making the money, but the farmer's family living expenses eat into those farms' profits. So in years when prices or sales are not as good, when farmers need to tighten their belts and get the family living down to account for the lower income and keep a farm at break even or above margins. I said before, in farming, the lines are blurred between personal items and farm items. It's very easy to put things on a credit card, for example, and for that balance to go up very quickly, whether it's personal or for farm. You keep using that credit card when your crops are growing, and then you expect to pay off like gas and groceries and personal items, and you expect to pay it off when you sell your crops. But before you know it, that credit card balance is too high to cover because you didn't manage your family living and personal expenses closely enough. In the end, many farmers end up taking money from the farm to help pay that debt down. And you are accruing high interest charges at the same time, which makes it harder to get out of debt. It snowballs very quickly. It's very common to see universities and managers not factor in term debt, income taxes, and family living into their analysis. They're only looking at production net income, not what is outside of putting a crop in the ground and harvesting it. If it can affect the farm, then I highly recommend you include it in your final net income, which is why I included those 4 items there on the right. So again, if you ever get an analysis back on your farm and they don't include those 4 items, I would quickly plug them in so you really know how your farm operation is doing, and as you as a family are fitting into that picture. So let's put everything together. Well, we started with your cash income statement, which is here on the left. And again, you can use this for your Schedule F and your taxes as long as the time period you're running it for is January 1st through December 31st. Then we went to your accrual adjustments. We took out the revenue and expenses that were not earned or used in the covered time period. After that, we factored in non-farm production items such as off-farm wages, family living, term debt, and income taxes. The items that you do not have an off-farm job, then your farm has to pay, okay? So if you look here, we have on the left, we have the cash income statement. Then we had the accrual adjustments. We got our accrual income, your net accrual farm income number, which is $900 from there. And then we had the non-farm items that we added in after that. So TLC farms went from negative $1,875 to a positive accrual net farm income of $900 to a positive $1,400. If a farmer does not have an off-farm job, then taking into consideration the family living, term debt, and income taxes will make the accrual net income decrease. But it's important to include them so that you know as a farmer what you can cover as far as debts, such as your tractor loans or if your family living is too high. I know I keep saying this and repeating it, but it's so important that you know where you are globally and anything that could possibly affect your farm. As a lender, unless there's an off-farm job that 100% covers family living and anything that could possibly come up in family living, I always include it in my analysis. If you look at TLC farms here, if they didn't have an off-farm wage, they would not have made money and they would have been greatly in the hole because they could not have afforded $35,000 worth of family living. They could not afford term debt and they could not afford income tax. Your family living includes like health insurance, tennis shoes for your kids, vacations, groceries, car expenses, your house mortgage. There's a lot of things that can affect your family living. And so that's important that if you have to get an off-farm job, that you do that to make things work. I know that I just threw a lot at you with income statements and accrual income statements, but just know that the more you do it, the better you will get. And again, you and I still have to stop and think about how accrual expenses affect the net cash farm income sometimes. So if you do not get it at first, do not worry. It will become easier. Don't be afraid to ask someone for help, if it's a local lender or someone at the FSA, or call someone like the Land Connection to get a recommendation for someone who can help. Okay, so that's basically looking at your past, your income statements. And that is probably one of the hardest things you're going to use, but you're going to see this play a part in doing the future. So with that, we are done looking at the past. They have $1,400 that they made once you include all the non-farm items. That's pretty good. In farming, you don't make money every year, but you try to get to break even or above every year, and you're still going to be farming the next year. So we just finished using income statements to look at the past. Now it's time to see where you are now. The financial statement we use to do that is the balance sheet. A balance sheet reports assets, liabilities, and equity, also known as net worth. I'll use that term interchangeably, equity or net worth. And it's at a point in time. If you look, I have that underlined and in bold letters for a reason. It's a point in time. It's as of this moment, where you are today. Whereas the income statement was for a period of time. It was like January 1st through December 31st. The balance sheet would read something like as of December 31st, which if you're making a note, I highly recommend you do a balance sheet every year as of December 31st to see where you ended up every year. There are three components to a balance sheet. You have the assets, which are anything of value that can be converted into cash and is owned by the farm or the individual. It is common to do a balance sheet that has both farm assets and debts, as well as personal assets and debts. You can do them separately or together, but most ag lenders will want them both in some form. I always do my own with both, because again, farm families, farm operation, farm families, the lines are very blurred on that. Liabilities are your financial debt or obligations. It is what is owed to an individual or to an organization. And the last thing on the balance sheet will show you your equity, also known as your net worth. It is what the farm or individual owns after all the debt is removed. The organization and layout of a balance sheet are standard no matter whether it's a personal balance sheet, farm balance sheet, or the balance sheet of a major corporation. The setup will be the same with only subtle differences. There are two things to remember for organizing the layout of a balance sheet. First, we put the most liquid assets or debt, or the debt we owe soon, at the top. Then the categories will get less liquid or more long-term debt as you move down the balance sheet. Most balance sheets will have a current and non-current section for assets and the same sections for liabilities. So you have a non-current and current assets, current and non-current liabilities. But agriculture is different than most industries, as it is in most cases. We break down our balance sheets into three sections: current, intermediate, and long-term. It follows the same concept though, the most liquid at the top, and then it gets less liquid as you go down. The other thing that is important for the organization of a balance sheet is assets are always on the left and liabilities are always on the right. Or another way to look at it is what you own is on the left and what you owe is on the right. Now, if you were going to go look up a balance sheet on Yahoo Finance of like a stock in a publicly traded company, a lot of times you'll see assets up top and then you'll see the liabilities below. That is also okay to do, but I like to have them side by side so I can compare them. So if you look on the right, you have your assets on your left, you have your liabilities on your right, and then you have your three sections. which then totals up into your total assets and total liabilities. So let's go over what is exactly included in each side of the balance sheet. We will start with the assets, which again are always on the left. Assets equal liabilities plus equity is extremely important to remember, and we will be using a variation of this equation on every part of the balance sheet. If you have a highlighter, I would highlight that equation. If your liabilities plus your net worth do not equal your assets, then your balance sheet does not balance and there's an error somewhere. So let's look at a micro level example of how this works. Most of us have bought a car at some point in our lifetime. So let's say you are buying a $20,000 car. If you pay a $5,000 down payment and you finance the remaining $15,000, then your equity in the car, your $5,000 down payment, plus your debt on the car, which is your $15,000, equals $20,000. 5,000 plus 15,000 equals 20,000, which is the value of your asset. Your down payment is your equity, your 15,000 is your debt, and your 20,000 is your value of your asset. As I have mentioned, and I will mention again because it's important, assets are on the left, and in ag there are 3 sections. The first being current assets. Current assets are the most liquid of your assets. That means they are the most easily converted into cash or are cash, and generally have a lifespan of less than a year. Below the current section are the intermediate assets. These assets usually have a lifespan of 1 to 7 years, or it's something that could last past the 7 years, but if you need to quickly get cash, you could sell them in a couple of days without too much paperwork or anything like that. Like it'd be really easy to convert it into cash. Not as easy as cash itself or inventory, but it's still easy. So then the last section, the last asset category, are the long-term assets. So let's go over each category to see what is included in each one. The first one we have, we're going to start with the top left of the balance sheet. And those are your current assets. Included in this section are your bank account balances at the point in time your balance sheet is covering. This is kind of very important because there's certain times of the year in which farmers will have higher bank account balances than other parts of the year. And I know it's tempting to use the time of year in which you have the biggest bank account, but again, this is covering one point in time, right? Not a period, a point in time. So as of the date that you're doing your balance sheet, what is your bank account balance? Also included are your savings and CDs balances, savings account balances, accounts receivable, inventory, so that's any produce or grain you have on hand, your market livestock, that's the livestock you were planning to sell within the next 12 months, and the value of your prepaid expenses. If you look at the example on the right, you will see that even within the sections, the most liquid items are always at the top, and they become less liquid as you go down. If you owed someone money, the easiest way to pay it and most liquid would be cash. It would be to write them a check or hand them cash. The hardest current asset to turn into cash would be to sell your grain, livestock, or to get the cash value of your prepaid expenses. Now, prepaid expenses, you might recall from the section on the income statements. If you have expenses that you paid ahead for, then that is an asset. So for example, if you have a farmer up the road that you have paid him money for manure value, for him to spread manure on your field, that is an asset. You have taken that money and you have given it to him with the promise of getting that manure. So he either owes you that money back, he's not going to give you the manure, or he owes you the manure itself so that you can sell it for cash value if you need it. So for example, for this year in December 2021, if you paid for that manure for 2022 crops, until you use that fertilizer, that manure, it is an asset on your balance sheet and can be turned into cash if needed. Once you put that manure on the field, it's no longer an asset in the current section. So that's your first section, top left. Right underneath that, underneath the current assets, are the intermediate assets. They sit right in between the current and long-term assets and normally have a lifespan of 1 to 7 years. Items included in this section are machinery and vehicles, cash value of life insurance, retirement account balances, notes receivable, which basically means if you loan someone money, then the balance they owe you are your notes receivable. Securities not readily marketable. This would be things like government bonds and stocks, breeding livestock, and personal items. If you were doing a strict farm balance sheet, in other words, business only, then you would not include your personal items. But again, including personal items and accounts will get you a global picture of your net worth. And it's because the lines are so blurred between your farm operation and personal, even for myself, I always end up just merging the two. And any customer that sits across from me, I do the same thing. I just do one big balance sheet for them so we know where they're at. So again, that's 1 to 7 years. That's machinery and vehicles, cash value of life insurance, retirement accounts, notes receivable, securities not readily marketable, breeding livestock, and personal items. Now you might be like, but I'm going to own that tractor for 10, 20 years. Yes, but generally we say for depreciation purposes, the value of it is 1 to 7 years. But you'll notice that I'm not including depreciation or appreciation on this balance sheet. This is a very simple balance sheet that most lenders will ask for. If you're going into a lot of detail, or you're a publicly traded company, then you're going to include depreciation on your balance sheet. But again, that is way advanced and you don't need to be a CPA to do this one. This one is accurate enough. Okay. And if you take it into any lender, he or she may have some questions to fill in the gaps, but it's still going to cover what you need. So again, it's okay to keep your machinery for over 7 years, but just know that over time, the value of that machinery might change. So if I have a customer, let's take TLC Farms, let's say their value of the machinery is $29,000, and in 10, 15 years, let's say 15 to 20 years, they never trade in or sell any machinery or get anything new. That $29,000 in about 10 years, I'd probably be like, let's devalue this a little bit, because if they were going to sell that item today, it wouldn't be worth that. And that's the question I often ask farmers is, what is the value of your machinery today? If you were going to go out and sell it to someone or to a dealership today, how much money would you get for it? Tractorhouse.com is a good place to look to see what the value of your machinery is if you're not sure. We use that all the time to kind of get a ballpark figure of what machinery is worth. The last asset section is on the bottom left, and those are your long-term assets. These would be items that are more permanent, such as farmland, buildings and improvement, and your residence. There are not usually a lot of items in this section, but these items generally have the highest value on a balance sheet. This section is called fixed assets because these items generally cannot move or cannot be easily moved. You cannot move your farmland, but you can move a tractor. So that's why they're long-term. Like they're going to be there not just in your lifetime, but for future generations as well. It's very long-term. And like I mentioned, this is probably going to be where most of your assets, the value of your assets sit, especially with the way land prices are going today. If you own any land, that's going to increase the value there. Now, the hard part with saying, well, I'm going to use today market prices, it's very easy for us to increase the value of your farmland, but it's much harder for us to bring it back down. So I do not recommend that you change the value of your farmland every time there's a change in market, because the market just changes so often. I wouldn't look at changing that maybe, and other farm managers and accountants might say different. I wouldn't look at it maybe once a decade, honestly, because again, as easy as it can go up these days, it could go back down. And all of a sudden you have a big change in your long-term assets. So I would leave those at a fixed amount as well. If you make an improvement on your home, that would increase the value on your home as well. So if you add like a garage, attached garage, a heated garage, or anything like that, or another bathroom, that might increase your value. So let's go over to the right side of the balance sheet, and this is where your liabilities are. This is not the fun side of the balance sheet. Your liabilities are your assets minus your net worth, and that equals your liabilities. If your assets minus your net worth does not equal your liabilities, then you will need to review your balance sheet until it does. Again, it's out of balance. What this formula is essentially saying is to take your total assets, subtract out what you have ownership in, and what's left is the debt you owe on it. So let's rework our new car example from before. Remember, you were buying a $20,000 car. You put $5,000 down. That means you finance $15,000. $20,000 asset value minus the $5,000 equity that you already own from your down payment, that leaves you $15,000 of debt left on the car. Just like the asset side, there are 3 sections. And if you notice, they're called the exact same sections. They're current, intermediate, and long-term. On the balance sheet, they get placed in the same order from top to bottom. And I highly recommend you line them up with the asset section. So if you look on our complete balance sheet, you'll see that my current liabilities ends on the same row as my current assets. They all kind of move together. So you have your 3 sections, your current, your intermediate, and long-term. So let's talk about your current liabilities. Current liabilities are due within the next 12 months. They include things like accounts payable, operating notes, accrued interest, real estate taxes, income taxes and Social Security owed, and any loan payments due within a year. Accounts payable were used in the accrual adjustments on the income statements, if you recall. Those are the items and services that you have used but not yet paid. So that would be like, again, if you did a tractor repair in December and you owe for it, but you don't pay it till like the next year or till after you run this balance sheet. If you have, let's say you have a loan on that tractor, then you would put the principal value of the loan payments in the portion of debt due within 12 months. That's the principal value. And the interest you owe goes under accrued interest. Now let's talk about the credit card debt a little bit. There are times where it might be appropriate to add credit card debt to the current liabilities. If you use a credit card for operating expenses, which I do not recommend doing, then I would put the value of the operating costs that is included in your credit card debt in the current section. Credit cards can also go into the intermediate liability section, but if you use it for your operating, you should be able to pay off at the end of every year, or you should be able to explain what's left over, and what's left over should either be debt that you're about to pay or prepaid expenses for the future year. So if you have a large amount of credit card debt that took you years to accrue, then I would recommend you put it into the intermediate section. So let's talk about the intermediate section. And again, if you notice the accounts payable, what is owed first is up top, and it goes down to your current portion of debt. That's kind of, it's owed within the next 12 months, but it may not be due like within the next 30 to 60 days. So the next section is intermediate liabilities. Much like its counterpart on the asset side, intermediate liabilities are debts with a lifespan of 1 to 7 years. Common items in this section are machinery debts, car loans, credit cards, and student debt. If you notice, many of these loans had the asset purchase listed in the intermediate asset section to the left of the intermediate debt section. So in other words, when you buy that new tractor and you get a loan for that tractor, you have the loan of the tractor, the principal amount owed on that loan for the tractor on the right, and you have the value of the entire tractor itself goes on the left. Student debt is not always due within 1 to 7 years, but it's best to put it in this section rather than thinking about it in the long term, because it is not secured by a long-term asset as collateral. And although your degree is a long-term asset, which they can never take away from you, it unfortunately does not get listed in your long-term asset section. Your asset to that is basically you use your degree to get a good job to then pay off that debt, which again, you can't put on the asset side. So I highly recommend putting it into the 1 to 7 year category so that you pay it off as soon as you can. So the last section are long-term liabilities. And this is the last of the liabilities. These are loans or debts whose length are longer than 7 years. The most common items found in this section are farmland loans, personal residence, so your house mortgage, and in general, a good rule of thumb is if it has a mortgage on it, then it most likely is in this section because it's probably going to take you more than 7 years to pay it off. Your house is 30 years. If you buy farmland, it's 30 years. It's going to take you a long time. You're going to have it for a long time. So they amortize that over a long period of time. Like I mentioned, sometimes student loan debt can be amortized over 20, 30 years, but I would never put it here because it's not followed, it doesn't buy something that's a long-term asset on the balance sheet itself. I also would never put credit card debt here as well. You should not be taking more than 7 years to take off your credit card debt. It's okay to put credit card debt in the intermediate section or the current section. And going back to that real quick, and I'm going to go back to the intermediate liabilities and how to do the tractor loans. So let's say you have a tractor loan let's talk about that car loan, for example, that we've been using all the time. That car loan, let's say you owe like $2,000 principal within the next 12 months. That $2,000 is your current amount. That goes up to your current section. And then that amount gets subtracted from what's in your intermediate section. You have this tractor loan here of $11,335. Let's say at the next time you do this balance sheet, you're going to end up paying like $3,000 of that in the next 12 months. You put that $3,000 up in your current section and you subtract it off the intermediate section. Okay, so that loan value at the end of your 12 months becomes $8,335. So this intermediate section does not include any payments that you're going to make within the 12 months. So this is going to only be the value of your loans after you've made all your payments within the next 12 months, because again, those payments move up to the current section. I'm sorry to go back and forth there. I forgot to mention that, and I definitely wanted to mention it. The same can be done for credit card debt. If you have a lot of credit card debt, you could have a goal of saying, I'm going to pay off like 25% of it within the next year. So you take your total credit card debt and you subtract off the 25% you're going to pay, put that up in the current section, and leave the rest in intermediate section. So you could have credit card debt in two sections. But again, if you have credit card debt, that's some of the debt you should be paying off first because it's very high interest and a lot of fees. So pay off your credit card debt as soon as you can. You really should not have much, if any, on your balance sheet if you can avoid it at all. But I understand that when you're first starting out, that might be something that happens, but again, I don't recommend it. So thank you for letting me skip back there to put that little note in there. Again, if you have questions on that, though, you can ask me. That can get kind of complicated, but if you're going to pay whatever you're going to pay off in the next 12 months, just subtract it from your balance in your intermediate. So whatever your loan value is today, minus what you're going to pay in the next 12 months, that's what goes in the intermediate section as far as your loan values. So we have the long-term liabilities. Again, this will last for a very long time. It's a very good feeling when you pay off these loans because they can last for decades. So once you have your assets and your liabilities, then you can calculate your equity. Again, that's also known as your net worth. Your equity equals assets minus liabilities. Sticking with our new car example, the value of your new car was $2,000. You financed $15,000, which means you have $5,000 equity in the car. You put $5,000 of your own money onto that car. You already own $5,000 of that car outright. $20,000 value minus $15,000 loan balance equals $5,000 ownership in the car. Your net worth is the value of all your assets minus your debts. That's a really good feeling. Over time, I would expect that number to go up. When you're first starting out in farming, that number could maybe even be negative. And especially if you have student loan debt, that number very well could be negative, and it could be negative. But if you're going into a lender with your balance sheet and has a negative net worth, just have it where you can explain it. So if you have huge student loan debt that is causing your net worth to be negative, just show, hey, this is my student loan debt. This is how often I'm paying. And then they'll also see on your credit reports, which we'll go over in webinar 3, that you do have that debt and if you pay it on time. So again, your net worth should go up over time, because you're going to pay off your debts over and over. Your kids are going to leave the house eventually. You're not going to have to pay for them. It's just going to be maybe you and another person, and that's going to lower the amount of money that you have to borrow potentially. So over time, you'll not only get more assets, but you also pay down more debt, and your net worth should go up over time. But it can ebb and flow in a lifetime. So don't worry if it ebb and flows. It happens. So if you, for example, 20 years into your farming career, decide you're going to buy farmland, your net worth is going to go up because you're going to put that farmland on the left-hand side of your assets, on the bottom left-hand side, on the long-term assets. But then again, you have to put the long-term liability in there too. So your net worth it evens out a little bit. You know, it balances each other out for whatever your down payment was, essentially. Just like that card example. There are 4 common things that can affect your net worth. It's earnings and losses, appreciation and depreciation, and inheritance. Appreciation and depreciation would be something like your farm machinery over time loses its value. We talked about that in the intermediate asset section. Taxes will depreciate an asset for tax purposes. That is a deductible tax expense. But for our purposes as loan officers, we like to say, if you sold it today, what would it be worth? Okay, so what you do on your taxes is for tax deduction purposes. But we don't include depreciation on most of our balance sheets. Again, we want to know, if you're going to sell today, what would that asset be worth? And it's the same with appreciation. We don't do one way, we don't do the other way either. And again, over time, certain assets can increase in value, but be careful about increasing that value on the balance sheet. Don't do it very often, honestly, because I know everybody wants to have it go up, but then it can go down just as quickly. So farmland, really good example of that again. Historically, it's gone up over time, but I would not expect to see your farmland value go up year after year if you do a balance sheet on the same day every year. I would expect it to go up maybe once every 10 years when the base kind of moves up with it. And then the last category is inheritance. If you inherit money or farmland, something like that, that will increase your net worth. That'll increase your net worth very quickly because there's no debt with that unless you have some estate taxes with that. So those are the 4 things that can affect your net worth. The most important of all of these, though, is the earnings and losses. This is the only thing that you can control as far as your net worth. The higher the earnings you make, the higher your net worth is going to be, the more assets you're going to have. And the worse your losses are, the lower your net worth. You're going to dig into your net worth to kind of pay off your bills. You're going to mortgage that farm ground. You're going to have to put loans onto your machinery and use them as collateral and everything. So that's where the hard part is. If your net worth increases because your earnings have increased, it indicates that you had like higher profit margins. So it's a good thing. That money you then can put in, you can do it to pay down debt or put it into a savings account. I would say whichever one earns you more interest or saves you more interest in that case. But if you earn money, then it either goes in there as an asset or you've paid down debt. But either way, it increases your net worth. So we've done the past, we've done the present. Now it's time to look to the future. The financial document we use for this is called a cash flow projection, or in simple terms, it's putting together a budget. The organization of your cash flow projection is not as formal as the income statement and balance sheet, but it should be able to answer the following 4 questions. Is it working or not? If not, then why? And what can I do to fix it? And how often do I need to check in? Those are pretty big. It's only 4 of them, but they're pretty big questions that need, good, accurate answers. It's important to start every year with a budget in place. This cash flow projection or budget will help you keep expenses in check and to know if you are meeting revenue goals to pay off all your expenses. Like I said, there's no set format for this statement. It's kind of however you want to do it, but I recommend keeping it similar to your income statements format. I recommend using the same categories for income and same categories for expenses. That way you can compare to the previous year's numbers to see where things have changed, or you can compare it to another checkpoint in the year to see how you have progressed or in some cases regressed. Again, you're going to compare it to your previous year's income statement for accuracy also. And what I mean by this is unless your production has changed a lot, in other words, if you didn't like pick up a lot of acres or didn't expand or decrease your production that much, then the previous year's or the market hasn't changed, in other words, the prices hasn't changed that much, then your cash flow projection for the upcoming year should resemble your income statement from the previous years. You know what you actually spent last year, and all else being equal, you should have the same for next year or close to it. So it's really good to use that as a basis. You will need to do some research to see if costs have changed for the upcoming year though. I highly recommend checking with your suppliers, your vendors, to see if prices are changing for the next year. If you get your seeds from a supplier, you don't save your own seeds and you get your seeds from a supplier, I would call that seed company and say, hey, what's it looking like this is going to cost me in the spring? Or that farmer that provides you fertilizer through manure value, I would call them and say, hey, are you planning on charging me the same for next year? Ballpark, you know, what's the estimate on that? And then I would also be prepared to update your cash flow projection throughout the year to estimate what you will need to get through the rest of the year and adjust as needed. If you notice, I put estimate in there because until something's already done, it's just an estimate, okay? From your original cash flow projection, you know what you have budgeted for the year. And by updating it throughout the year, you are entering the amounts you have already spent or earned in the beginning of your fiscal year, then using that information to estimate what you have left to spend and earn yet. Sometimes a farmer will have unexpected expenses, and that means adjustments will need to be made to break even for the year. By updating your projections regularly with actual numbers throughout the year, you can make changes before it's too late. Okay, a lot of times you'll catch issues early and you'll be like, oh, I can fix that real quick. But if you wait till the end of the year, it's going to be too late to fix anything. So let's go over how I would recommend putting your projection together for the year. This is also how I put my own projections together on my own farm. Again, I would never recommend you do anything that I wouldn't do myself. And this is kind of what I follow to do, not only for my customers, but for our own operations. So like I mentioned before, there is no standardized format that has to be followed. But the components that need to be included are mostly the same. I recommend you start by copying and pasting your final cash income statement in the column right before your projection column. So basically, the first column is going to be the past, what you already know. And this way you can easily reference it and make sure that you're within the ballpark when you're estimating or projecting for the year. Okay, so if you look over here on the right, we have at the end of the fiscal year, TLC Farms had produce at the end of the fiscal year, they earned $43,000. For their eggs, they had $2,700. For the 2021 budget, we're projecting that to go up a little bit, which is good. So $46,000 in produce sales and $3,500 in eggs. And then for fertilizer, seeds, gas, all that, the cash farm expenses, we also have those go up. Now you may be asking me, do I need to do it on the accrual basis or the net income basis? For simplicity, you could do it on cash. Again, cash is very simple. At the very least, I highly recommend you do cash income statements. If you get into the accruals, and rather than making the adjustments on the big categories like just accounts receivable or just accounts payable, if you actually take the line items and you make the adjustments for like fertilizer, you had like, what was it? I think for, well, let's do prepaid. So like prepaid expenses, I think it was positive 1,705 for like, it was like fertilizer and something else, but let's just say it was all fertilizer. You just have to add or subtract it to that line item one by one. So then overall, you're still going to get the same net farm accrual income, but you're, again, like I'm just saying, it's kind of hard to do it that way. And for simplicity's sake, I would just use your cash. Unless your accrual changes greatly, then I would maybe go into the nitty gritty and do it line item by line item to see what you actually need for production. And again, your end of fiscal year 2020 income sheet is just for reference. If you know that you prepaid for a bunch of seed or gasoline or fuel at the end of the 2020 fiscal year, then you know you might need to lower it for your budget for 2021. So like I said, this is not as formal as the income statements and the balance sheets. This has a little bit of wiggle room because you're dealing with your estimates. Make them as real as possible. Call your vendors, see what you're going to have to pay for that. But again, keep it in line with last year's spending. If TLC Farms were going to come in here and double their income, they're that optimistic, and they're one of my customers, I would need to say, okay, what changed in your operation from last year to this year? Did you pick up more acres, or do you have a contract with a local restaurant that's going to cause you to double? Or there's a lot of things you can't predict in farming. You have to do your best to budget, but make sure it's realistic. Otherwise, it's not a tool for you. It's not going to be any use to you. So to update your projection throughout the year, you will need to have accurate and current farm records. We talked about farm records at the very beginning of this presentation. It was the first thing we talked about because, again, it is the most important tool you have on the farm, the most important tool you have on the farm. So make sure you are updating your farm records often, and you can double check them as much as you possibly can, but don't wait until the end of the year to update your farm records. I would do it, at least make sure that every quarter you have, well, for lack of a better term, closed your books, that everything for that quarter you are sure about and it's done. You will need to know, to update these projections, you will need to know how much you have already spent and earned, as well as what you project to earn and spend for the rest of the year. By combining what has already happened, in other words, your actual numbers, with what you project for the rest of the year, you will be able to project where you will end the year using some actual numbers and not just estimates. So again, it's not going to be 100% actual until you actually go through it, but half a year of actual numbers plus half a year of estimates is better than using a whole year of estimates. So halfway through the year, at the end of June, maybe you sit down and update your cash flow projection to see where you are. So let's say TLC Farms, as of June 30th, they have spent $10,000 on, or let's see right here. They have spent $10,000 in fertilizer, and they're predicting they'll need an additional $5,000 to prepare the soil for next year. That means they are projecting at the end, they will have $15,000 worth of fertilizer expenses by the end of the year. They've already spent $10,000. If you look in the actual column, they've already spent $10,000. I'm sorry, they budgeted $12,000. They've already spent $10,000 by the end of June 30th, and they're projecting they're going to need another $5,000 to get them through the end of the year. So that $10,000 actual plus the $5,000 needed for the rest of the year is $15,000. So somewhere their fertilizer expense has gone up $3,000. Maybe that farmer decided he's going to charge more. And so you need to make adjustments. And the way you do that is, again, those three things we talked about. You increase your revenues or you decrease your expenses. Maybe somewhere else you don't invest in a new greenhouse or something. That's a decision you're going to have to make, but you have to cover that expense. So you might have to have some adjustments that have nothing to do with fertilizer whatsoever in order to cover that additional $3,000. Look, this is the whole thing put together, and it looks complicated. But again, if you stay on top of your records, it's just filling in the gaps. It's filling in cells on a spreadsheet. You have your first column, again, which is your cash income statement, or if you have an accrual income statement in which you actually adjusted the line items, just not categories as a whole, you can put that in there. And it's only used as a reference. It's only used as a reference there. And then you have your budget in line in the second one. So this is what your goal is to stay in here. You want to exceed your goal for farm income, and you want to be under your goal for farm expenses. And then if you notice, I have something called beginning working capital. Beginning working capital, and we'll talk more about this in the second webinar, is your current assets minus your current liabilities at the end of your fiscal year. And what this means is basically it's the money you have left over for operations after you pay all your bills for the year. So in this case, TLC Farms has $1,075. They're projecting they're going to make $1,700 cash, and then their cash income. There's no accruals included in that. And then they added in the $1,075 they're carrying over from a previous year. The next column would be what you've already done. So you could do this every month. You could say as of January 31st, as of February 28th. You could do this every month if you wanted. You could do this every quarter, okay? But this would be your actual column. Then you have your projected through the remaining of the year. What do you need to get through the rest of the year? You add those two columns, and that's your projected final income statement. So you know right now, TLC Farms knows right now, adding all of this together, they have a change in cash position of negative $2,225 in the negative, but they're still projecting a positive cash flow margin. Okay, so what that tells me is they've worked through all their working cash, and they're only going to come out with $550, which is $2,225 short of where they were before, what they projected at the beginning of the year. So like I said, things change throughout the year, and you have to change with it. Is updating your cash flow projection worth it? Yes. It is work to update your cash flow projection throughout the year, though. It is work. It's work that doesn't involve you being outside, working with the animals, or being outside, working in your greenhouses or on the tractor and stuff like that. It's not the stuff that us farmers really enjoy doing. It is that time that you need to carve out for yourself, doing your records and having good records so that you can make good business decisions. It is worth it to at least update it once in your fiscal year. I would make it somewhere in the middle of your seasons, where some things have already happened, but you can still make adjustments in either your crop choices, or if you put some added or something on your fields like fertilizer, you can still make those adjustments. Because once things have happened, once it become actual numbers, you can't change it. There's no power in that whatsoever. You can't make any adjustments. If you are having financial issues, I recommend doing it no less than 3 to 4 times a year. And I know you're sitting there laughing, being like, Sarah, that's a banker talking. Maybe, but I'm also a farmer. And if I was having financial issues, even if it was hard to look at, I would want to know. In farming, you don't have a lot of power over things. You can't control Mother Nature's. You can't control the market prices. You can't control a lot of things, but you can control this. This is something you can control. And there's only one way that you will catch issues and be able to make the adjustments before it's too late. If you always waited for December 31st to see how you did, then you cannot do anything about the issues. It's like having a football or a soccer match going on, and the coach doesn't make any adjustments if they're losing. He just says, I will stick to the original game plan. And at the end of the game, he goes, oh, shoot, I wish I would have done that. Don't be that coach. You know, if you have to make game time adjustments, make the game time adjustments. Your year is done at the end of the year, and there's nothing you can do at that point. Once your production season is done, you can't go in and decide, well, I'm going to grow something else. Don't have any regrets on that. And again, if you only do the updates towards the end of your production season, it's too late to make adjustments a lot of times. You won't know if maybe your revenues are lower than they should be or your expenses are higher than they should be. Knowledge is power. And if you do cash flow updates, then you know to make changes to ensure your farm makes money or to limit a loss. There are years in a farmer's career where the best you can do is limit a loss. You need to make adjustments as much as possible. And in those years, you just need to hunker down, limit the loss, and next year you're going to have to cover that loss plus make money on top of that, okay? Always go for break even or making money though. If you're breaking even, you're still in business. Projections and updated projections are good indicators. And like I said, farming can be unpredictable. So if you have negative cash flow update in the middle of the year, do not panic, okay? Analyze why it is negative, you make your adjustments, and you keep going. We'll talk about some of those adjustments in the second webinar, okay? Just don't panic. There are things you can do. The true indicator of whether you made money or not is at the end of the season when you've sold your produce, okay? You might have a really horrible June and July, but a fantastic August and September. And that may make up any losses from earlier in the year. It's all about being flexible and adjusting as needed, okay? All of these things are tools you can use, okay? I know I went through the future a little bit with the cash flow updates, but again, it's basically taking what you view as a realistic budget and then just updating it over time, okay? And I'm really stressing the future at this point because we're cash flow lenders at Flanagan State Bank, which means we look at are you going to be able to pay this debt in the future, in the upcoming year, not what have you done in past years. So if you had a loss last year, we will factor that in, but then we'll look at what you're going to do this upcoming year. And we'll say, okay, adjustments have been made. This is where we're looking. We're going to get you to a positive margin. You need to have that same mindset with your own business. So by updating your cash flow throughout the year, you can more easily answer those 4 questions that I had on slide 27. And in case that slide number is wrong, I'm talking about those 4 questions that we started the future section with, okay? Is it working? That sort of thing. If not, how can I change it? So let's talk about final thoughts on financials. You don't have to be an accountant to put good financials together. This stuff is not easy. It was not easy for me. I had to work at it. And you don't have to be an accountant to do it. And if you think this is too hard for me, I have seen engineers from Caterpillar, guys who design and build those huge pieces of equipment. I have seen them sit there and get frustrated with a balance sheet. So things I do on a daily basis and I think, oh, they're going to have no problem with this. It's just numbers. Oh no, frustrates them to no end, It's not easy, okay? And most of you are really good farmers. You're good at going out there and putting the crops in the ground and harvesting them and getting livestock and taking care of them and everything. This is not what you want to be doing, but it's so important that you do. You don't have to be an accountant to do it, okay? You can do it. And then hopefully if you ever have to take this into a lender, it's just about filling in the gaps. Maybe they have some questions on something you maybe didn't put in a financials, okay? Your farm records are the basis of everything. Accurate farm records leads to accurate financials, which leads to sound business decisions, okay? This is what it's all about, is running a business. You need to take the emotion out of your operation and run it like a business. All of us are emotionally attached to our farm in one way or another. It was either grandma and grandpa's farm and you inherited it, if you have that privilege, or it was something that you worked hard to purchase and you worked hard to grow and you're very emotionally attached to it. It's like one of your kids, but it's not one of your kids. It's a business. You need to take the emotion out of it and do what you need to do to run it like a business. You need to grow as you're profitable and when you can afford it. These financials will help you tell you when you're making money. If you are looking at, let's say you're looking at purchasing a new delivery van that's going to help you make more deliveries and make it further outside of the current region you're at, you're not going to know if you can afford that delivery van unless you run your numbers and know that you're profitable. Okay, you're not going to know that unless you know you have positive net worth that you can afford to pay the loan payment. In some cases, you need to know that you have, that it's going to bring you enough new money to pay off those debts. That's stuff that we're going to talk about in webinar 2. But don't look at your neighbors. You do your own business plan and you stick to your plan. You plan your work and you work your plan. Okay, you grow when you're profitable and when you can afford it. And sometimes that's at a snail's pace. Okay, it's very slow at times. Utilize your farm records for more than just tax planning. Have I mentioned that they're the most important tool on your farm? They are the most important tool on your farm. They can make you profitable. Okay, they can help you in years when money is tight, when it's a down year, when you're looking at a loss. It can help you limit the amount you lost. It is probably, and again, I know it's the least favorite part of most farmers' job, but use them for more than just tax planning. Use your farm records to make your business decisions. It's like that thing they always show on NBC, the more you know. Knowledge is power. Your farm records will give you power. Take the time to make sure they are accurate and detailed. And last, I would be shocked if there are not questions with this. I went over a lot of stuff in a short amount of time. So if you have questions, this is my contact information. Email me or call me. I am a resource for you. Even if you're not a customer, I am in it to help any farmer who needs it. So if you have questions and you're doing this, give me a call, shoot me an email, and I could even get on a Zoom with you and help you walk through some of this. That's fine. My goal is to help small farmers make it to the next generation, pass on these farms. So if you have any questions, let me know. Next is the second webinar is on how to use these financials and analyze them. You've done the hard part. You've done the records. You've done the financial statements. Now you got to do the math. You might think math is hard, but you already done all the hard work. You've put everything together. Now it's just plugging in numbers. So if you have a second, I highly recommend you go to the second webinar and look how you can use your financials to grow your business and to analyze your business. These financials don't mean anything unless you can analyze them. So thank you for watching this webinar, and I'll see you next time.